Trump, as an example, is a divisive figure. People like him, people don't like him. Their expectation as to the success or failure of the Department of Government Efficiency is often, hidden rhetoric about him. The Department of Government Efficiency is not going to work. We tried it in 1980 with the Office of Management and Budget. The most recent Trump budget, where he proposed scrapping the debt ceiling, but at least raising it, and proposed the fourth highest deficits in U.S. history, tell us everything you need to know about the Department of Government Efficiency. This isn't a criticism of Trump. This is simply to say, divorce your narrative, divorce your politics, divorce your feelings from arithmetic. That's all I'm asking people to do. If you can feel perfectly comfortable with the direction of the country and the society of the country, but when you look at the fact that the cost of living, as I see it, is increasing by 7.5% or 8% compounded, and the interest that you receive on U.S. government securities is 4.5%, pay attention to the delta, not your preference. That's what I would ask people to do. What I'm doing, the S&P 500 is so overweighted the big tech stocks, and I'm not smart enough to know the impact of their technology. There's a lot of people who don't care about things like fundamentals. I happen to be one who does, and if I don't understand them, I don't play. And I don't play in the S&P 500 because I don't understand the dynamics of 30% of the market cap of the S&P 500. Short-term treasuries, I have to be a bull. Despite the fact that you are receiving a negative real interest rate, in this circumstance, any investor who isn't maintaining liquidity is a moron. And short-term treasuries, I would define as less than 2 years, are a wonderful place, except for the fact that owning them is treasonous, a wonderful place to park money. Long-term treasuries, I wouldn't touch them with a barge pole. I wouldn't buy them with the money from somebody I dislike. I believe that interest rates rise, which means the capitalized value of those distributions fall. I believe that the purchasing power of the coupons that you're going to get in the future are going to be worthless. In the decade of the 70s, the prime rate went from something like 5 to something like 16. People who held long-term treasuries, there's a woman named Horace Dodge from the Dodge family. She was in the safest possible investments, which is to say long treasuries. And I think her net worth declined by 80% over the course of that decade. Hardly riskless. I'm acting as though we are going to have an economic slowdown, and there's a high possibility of a liquidity-driven panic or sell-off. If I'm wrong, that means I suffered opportunity cost. Done that before, no problem. There's very little doubt in my mind that the gold trade continues, at least in nominal terms, because of what I see as the inevitability in the decline of the purchasing power of the U.S. dollar and the inevitability of negative real interest rates. By real interest rates, I mean the delta between nominal rates and deterioration of the purchasing power of the currency. If the gold price continues strong, the margins of the best producers will continue strong. Their share prices will increase at the same time that their free cash flow increases, and their only way to maintain production is going to be to buy other people. That's going to happen. At the same time, guys like Rick Rule, who thought that Franco-Nevada and Wheaton Precious were dirt cheap 3 years ago, will begin to look for sectors in the market that, while risky, are relatively cheaper. And so it's a virtuous circle. The big guys, the liquid guys with the high stock prices, the low cost of capital, take over the little guys. And if they don't get there quick enough, guys like me do. The higher gold goes, the less attractive it is to me. I'm a value buyer. I don't buy gold because I think it might go from 3,500 to 3,750. I buy it because I'm afraid it's going to go to 1,200. I'm not a trader. Given that I'd like to buy more, I'd rather see it cheaper than more expensive. We've moved into the market now where the high quality companies, but not as high a quality as what I would have talked about last year on your show, the Francos, the Wheatons, things like that. Leadership is changing. I still think for most people who aren't willing to do the work that they should settle for higher quality companies and a little bit less performance. In other words, they should still buy the best of the best, unless they're willing to do the work. That's a different question. If you're talking about the sector as a whole, leaving out the penny dreadfuls, you know what I'm saying? Leaving out the sub-$100 million market cap where they're just looking for this stuff, but they don't have any. I think you need to give the gold mining industry, in your parlance, a 90. The leadership has already happened by gold. We are already seeing margins blowing out. We are already seeing aggressive investments by bigger companies into smaller companies. We are probably a quarter of the way through this bull market, and it's the end of the bull market that provides jaw-dropping gains if you're smart enough to take them. Physical silver, I am still a little more ambivalent about. I don't know when the trade's going to take over. And I've always been myself, as a metal investor, a gold guy, because I've always owned it as insurance rather than as a speculator. So I would say myself, with regards to physical silver, I would have it as a 4 on a scale of 1 to 10. That means in your parlance a 60. But I would caution that your listeners need patience. It could easily be 2 years or 3 years before silver breaks out. It could also break out next week. If you talk about the length and breadth of the silver mining industry, which is to say all the penny dreadfuls that don't have any silver but they're looking at it, I would have to say that the industry as a whole is a 7. It's an enormously inefficient business, filled with dreamers, scamsters, and frauds. And that extends pretty far up the feeding chain. There are a couple stocks that are amazingly responsive to the silver price that are lousy companies. If you, however, confine your picks to the higher quality companies with higher quality, higher grade, larger accessible deposits, this is the sector that has the most upside relative to current market caps I know. So I guess what I'm trying to say is, if you are a good stock picker, if you are willing to do the work, you're talking about a sector that can scream. If you aren't willing to do the work, go do something else with your money. Copper's going to take a little time, I think. It's inevitable. But I would have copper as a 5 right now, simply because I don't see the copper stocks or copper as being overwhelmingly cheap in the near term. $5 is not enough money to bring a lot of new production online, but it is enough money to incent current production and to maintain sustaining capital investments. And if we are on the cusp of a recession, or if we're in a recession, then in the near term, the copper quote goes lower. I'm not saying that will occur. I'm not smart enough to tell you. Uranium, the metal, I would have as a 4, so you would have as a 60. I think it's under-owned, and I think it's underappreciated. Yeah, there is the lunatic fringe on X, which I'm part of, but really, if you took it out to the investment community as a whole, they couldn't spell uranium. If you give me one name, Cameco, I've upgraded Cameco to a 3, which you would have as a 70. My concern with Cameco was that they bought Westinghouse, and I didn't know that they knew how to operate an engineering firm. The first quarter, Westinghouse was in their control. It looks like my worst fears were going to be confirmed. This last quarter was a blowout quarter. And if we are, in particular in the United States, going to see a new construction renaissance, I'm not saying that we will, the technology that we will use will be Westinghouse technology. These will be American reactors built in America with American money. It's difficult to understate how important that is to Cameco. Cameco will supply the uranium, they'll supply and operate the reactors, they will supply the refueling and reprocessing, and they will supply the disposal. If it occurs, will be an annuity, never mind lasting for my lifetime. I'm 72. It's an annuity that'll last for your lifetime. As a commodity, I probably have it as a 4. It is selling, I would suggest, at a price that doesn't incent either sustaining capital or new project investing. And the cost of capital is going up. Interest rates are going up. Oil stocks are going down, which means the equity cost of capital is going up. Drilling in popular U.S. basins is declining rather dramatically. So I'm pretty attracted to it, but it's economically sensitive. We are seeing the oil price falling even as production falls, which suggests that never mind forward-looking demand, but current demand is much less than the market was forecasting or is accepting. So in the near term, you could easily see softness in the oil price. Let's go to the best of the best. A major integrated with a 30-year track record of intelligent deployment of capital, efficient upstream, efficient downstream, with a discovery in Guyana big enough to move the dial for Exxon, a circumstance where the industry is underinvesting, according to the International Energy Agency, $1.5 billion a day in sustaining capital, and Exxon is increasing sustaining capital investments and bought Pioneer for $60 billion. For most Americans, lazy people, you can basically buy Exxon and relax for 5 years. Will you be happy at the end of 2025? I don't know. But by 2030, you'll be ecstatic. We talked about a year ago, I guess, you and I, about the fact that the U.S. natural gas stocks were felony cheap. And gas was felony cheap. It's no longer felony cheap. It's merely cheap. So some of that's out of the trade. But the truth is that Devon, Equitable, the bigger, better U.S. gas producers have a long way to go. As the oil price recovers, it will drag gas along. And gas is already up by 100% in 2 years from an oversold bottom. The real wild card to me is the Canadian sector. The Western Canadian Sedimentary Basins spectacular basin that is very lightly drilled compared to U.S. basins. Canada has a pretty good energy infrastructure, transmission infrastructure. They have great human resources. They have a good provincial regulatory environment. What they have had for the last 10 years is a federal government that was hostile to the existence of the industry. The new prime minister is sort of schizophrenic. He suggests that carbon discussions will be central to financial policy, which suggests he's not friendly towards the energy industry. But then he says that they need to make Canada an energy superpower. My hope is that because he is a banker, he understands that the country is broke, and that in order to fund his domestic spending priorities, he will need to steal more money from the oil and gas industry, which means he will need an oil and gas industry. Perverse, but if that's correct, a basket of decent quality, mid to large cap Canadian oil and gas stocks should do spectacularly well in the next 5 years. They're selling for half the price of their U.S. peers, and their U.S. peers are cheap. The risk that you take is that the political establishment in Canada, if you will, the Laurentian elites, are hostile to oil and gas, and they'll have to deal with that headwind. In the United States, by contrast, irrespective of what you think about Mr. Trump, he is changing the regulatory climate around oil and gas, repealing existing executive orders, telling the regulatory agencies to get the lead out, not changing necessarily the regulation. But I suspect that the U.S. oil and gas industry will have 4 years where they have dramatically different relationships with the regulators than they had under Biden.